In today's lecture, we're going to cover mainly the key terminologies of financial products, financial institutions, and who are the main players. We're going to demonstrate the basic understanding of why the financial system exists and potentially give you food for thought if it didn't, so you can go away and explore that. We'll cover the various product types, just to kind of give a surface level covering of what they are and their characteristics. But when we cover this, as I mentioned previously, the rest of the module kind of goes into a bit more of a deep dive, and the stuff we cover today potentially will be recapped in a whole new week, and you might get a full lecture on a topic I briefly introduced you to today. And then at the end of this, we discuss the elements regarding central banking. To start with, pause this video and try and take in this image. What am I trying to represent by providing you with this diagram provided by Sihak, who worked for the World Bank? Okay, it is a little bit old, 2012, but it's the most up to date I've got. But take a moment now to think, what is this image trying to show? Essentially, Sihak was trying to give a visual representation of what the financial system looks like and where most of the wealth is created in a visual diagram of global wealth. And as you can see, the likes of the United States is massively inflamed compared to the size of its geography, to take into account that the majority of the financial system sits within the US. But also, look at the relevant scale of the United Kingdom. Quite a lot of financial services still go through London. Even with the Brexit agreement, the financial passport concept you may have heard about in the media, is that still most financial products, not people, products, transactions, still flow through the City of London, which gives us a main stage on the world when it comes to financial services. And the UK also benefits from the time zone we're in. On the flip side, you can see how small the likes of South America and the African continent is compared to the likes of Europe and China and the US, of course. Also, Japan is inflated quite a lot. Now, I've said this image is dated, but if we look since then, in 2012, a list of globally systemic, financially important institutions was created from the IMF, the National Monetary Fund. And this list is updated annually, and it basically looks at the banks and the financial institutions which are globally systemic. Kind of, if they go down, the system goes down with them. It's this kind of simple way to explain this. And back in 2012, when this diagram was produced, the majority of the institutions in that first list were really from the UK, America, and Europe. With only a couple from Asia, mainly Japan. But as that list is updated annually, I think now there's about 28 banks. But what we've seen is the development of the likes of the Chinese banks and some banks in Asia. So over the last couple of years, we noticed that the four large Chinese banks entered this list, but then slowly crept up the list into different buckets of importance and how much capital they must hold. So this diagram still holds true. However, we have seen the emergence of the financial power coming from China, with its four large financial institutions becoming more globally systemic. It'll be interesting eventually if Sihak ever produces a future diagram of this, say next year, so that, to give a decade's different. It'd be interesting to see what it looks like. I wouldn't imagine too much change except from the UK dropping a little bit because of Brexit and the emergence of China becoming more important potentially. So, some food for thought. Think about, what if there was not a financial system? What's the purpose of having a financial system? Majority of times when I ask people this in a real lecture, they kind of think it's something to do with the payment mechanism of how do we transact with one another. Well, that's only a small element of the financial system, a very important one, because if we couldn't pay each other, how would we value anything? How is the financial system changing? Think about that as well. What have we seen over the last few years? The development of cyber assets. I'm not going to say currencies, because many central banks around the world don't acknowledge the concept of a digital currency yet. However, just this last year, in 2020, the IMF did produce a paper on the foundations and the principles if any central bank would like to adopt a digital currency. So actually calling it a digital currency, moving away from the concept of digital asset. So no one recognises one as yet. However, the IMF have produced a document which outlines the kind of key principles central banks should take into account when creating a digital currency, but a centrally bank-governed digital currency. So that was from the IMF just in 2020. I think it was October, so quite recent. So all of these things kind of come under the umbrella of what is the financial system. But the key concepts are here. As a government, how would they pay for anything? Would they get enough revenue, whether that be through taxation or, in the likes of the UK and the US government's current policy, is borrowing? What would the concept of borrowing look like if no financial system existed? Who are the governments borrowing from? Ultimately, how would we value anything? If you go into your wallet now and pick out whatever currency you have in it, have a look at that currency. What does that currency say on it? If you've got a British banknote in your pocket right now, pick it up, look at it. It says, I promise to pay the bearer the sum of. What does that mean? What is the currency backed by? People think the currency is backed by gold. That ended a very long time ago, and we'll cover that in the foreign exchange lecture. So what is that banknote that's in your pocket? It's a promise. If it says £5 on it, why is it £5? It's only £5 because we all agree it's £5. And we have faith in our central bank that it's backed and that money supply is controlled. But currency, fiat currency it's called, which we'll go into in the foreign exchange rate lecture, is just a promise that we'll pay one another and that we all agree its value because we have confidence in our central bank. We have confidence in our currency. If we didn't, then you'd get examples of hyperinflation, where you're running around with wheelbarrows full of banknotes that keep depreciating in value. Recent examples of Venezuela, the more historic of Zimbabwe and the Yugoslavian Republic, were examples of where currencies just collapsed because no one had faith in the value. So, the textbook definition of why a financial services system, sector, whatever you want to call it, why a financial system exists, is the bottom bit there, to allocate resources efficiently. Now what on earth does that mean? Well, there's a good diagram on the next slide to demonstrate what we mean by allocation of resources efficiently. But we're really talking about financial resources. Essentially people who have money getting money to people that need money efficiently. So that's the best answer. But ultimately the goal of any financial system, certainly in a capitalist society, just like most Western economies, is to create wealth. If you have a banking sector that can issue loans, it can take deposits in, it can transform them deposits to loans and lend out to other people to return an interest, then that generates wealth. That loan creates interest payments to increase the bank's profitability so they can lend out more. But that loan that's being used by someone, they borrowed to invest in themselves, whether that to be buy property to make them feel wealthier, or if it's a business to buy machinery to be more efficient, to generate additional profit, then that in a capitalist society is what generates wealth and increases the prosperity of populations. That's why the likes of the UK and the US government tend to borrow a lot to invest in the country to generate future tax revenues, but ultimately make the country more efficient, better infrastructure, and ultimately more prosperous. And that's the idea of generating wealth in a capitalist society. Obviously, other factors of this, it does obviously allow a payment mechanism system. It does give a marketplace for assets and services to be priced accordingly. Financial systems have marketplaces where we can trade items and services. And nowadays, even trade and price future claims to wealth in the derivatives market. Nowadays, we can even trade likes of cyber assets. How on earth are they priced? And what's the rationale behind their price? All of this is dictated within a market of buyers and sellers and supply and demand. So the top four, obviously the benefits of having a financial system, but the concept is it allocates resources, financial resources, efficiently. So let's have a look at this diagram. And a similar diagram is found in the first chapter of your full textbook, but it looks something like this. Ultimately, a financial system gets money from people that have it, the supplier of funds, and it gets it to people that are demanding funds, people that require money for whatever reason. And as you can see from this diagram, there's kind of three routes you can go. There's the more direct route, where money can go straight from people who have it to people that don't. That's not as common. It's not often you walk down the Northumberland Street in Newcastle and you see someone with spare money waving it in the air going, who wants to borrow this? Because I wouldn't want to do that on Northumberland Street. Bit dangerous. I'm not saying Northumberland Street's dangerous, but let's be honest, if you walk around waving cash around, you're asking for something. So direct transactions don't really exist. But do they? Following the financial crisis, an additional regulation, certainly when it came to lending to medium-sized businesses and the potential credit risk that they faced when lending to certain organisations, banks stopped lending to these companies because they were worried they wouldn't pay it back. So therefore banks had to hold more regulatory capital to mitigate if companies didn't pay them back loans. So the likes of the crowdfunding sector on the internet appeared. And crowdfunding is really the modern day equivalent of direct transactions, where you can go to the platform, and on the platform literally is just a platform where demanders of funds request demands and what they offer in return, and suppliers can go on there and then donate or loan out to the fund demanders. So technology and regulation has allowed this method of direct transaction. But on the whole, it typically could be more expensive to do this. It's not that efficient. It could be quite sporadic. Some GoFundMe pages get nothing, some get lots. So it's not very efficient. Then you have route 2, which I'll say is the top one, where you go through the financial institutions. And we'll explain what these different companies are shortly. But this is the route we'll most be familiar with. If you want a loan, where do you go? You go to your bank, don't you? If you want a credit card, where do you go? You go to your bank, or credit union, or building society. And that's where we typically go because we know they have funds. But they get the funds because they have savers or depositors. So when we have cash, where do we put it? We don't put it under our bed nowadays. I would be interested to know how many people have piggy banks. But typically we put it into a deposit institution, like a bank. And then the banks transform our customer deposits into loans. So it's kind of a place in these institutions where they can manage how much they have going in, how much they have going out. And banks can model this. Banks know that out of 10 depositors, only one's going to withdraw it in the next day. That's a simple example. But banks can model how much of their deposits stay, are classed as sticky. And the rest can be lent out, as long as they keep a certain reserve for liquidity purposes, can be modelled using historic trends, then they can lend the rest out to demanders to create wealth. And the last example, is the bottom one, is through the financial markets. And this is really the kind of pricing and trading of financial securities. So the likes of a demander of funds can issue a product, which we'll talk about throughout this module. They can issue certain products in the financial markets that the suppliers of the funds buy, investors buy. So a company could issue commercial paper, which is a short-term loan in the money markets, and the supplier funds, an investor can buy that product, which yields a certain interest, and that would be through the financial markets. So the supplier of the fund will have a product that will yield an interest or return, and the demand of the fund will have a debt sold by the markets. So in that you have the money markets, which are less than 1 year, and there's 5 money market products we'll talk about in this module, and then there's the capital markets, which is the bond market and the equity market. Again, we'll teach them in 2 separate lectures. But as you can see from the diagram, there's a heavy interaction between the financial institutions and the financial markets. Because the financial institutions themselves are suppliers of funds, but they're also a demander of funds, whether that be short-term or long-term. So there is a heavy interaction between the financial markets and institutions themselves. But there is some things missing from this diagram. Where do the regulators sit? Where does the central bank sit? Is it in this diagram? Or do you draw a ring around the whole diagram and say, well, it covers the lot? So as I noted, we don't really discuss the role of regulation in this module. It's covered in financial markets institutions next semester. But we do note at the end of this lecture the role of the central bank. And central banks differ around the world and their rules differ. But to give you an idea, in the UK, the central bank has to hold a reserve for the banks. So the banks and the financial institutions must have a reserve account with the Bank of England. But the Bank of England is also the prudential regulator, and they regulate the sound and safeness of the financial market and the financial system. So they regulate the safety of the financial markets and the institutions. It doesn't regulate the conduct, the behaviour. That's done by the Conduct Authority, which is a separate regulator, not part of the Bank of England. So this is a good diagram of the financial system in a capitalist society, but it doesn't include everything. Always, when you see this diagram, go, where's the regulators? Where's the central bank? And you could also argue, where's the government involved in this? Because the government is typically the demander of the funds. But depending on which country you're referring to, governments could potentially regulate or be suppliers of funds, depending on the country. So it's a good diagram, but not perfect. But the idea is to allocate resources efficiently. So some key terminologies here. So in that last diagram, we had the concept of suppliers. Who are these suppliers? Well, these suppliers are people that lend out money, people that have the money. Financial institutions accept deposits, therefore they have funds, and they can lend out. Typical lendings from banks and building societies is in the form of mortgage loans for real estate and equity in property. But you'll be familiar with the likes of credit card companies and short-term loans. The concept of a borrower. Who are the demanders of funds? Well, this could be anyone. Me and you, we demand these loans. The government is the biggest borrower in any capitalist society if it runs a deficit budget, which the likes of the UK and the US does. But obviously business. Businesses are lenders as they want to make themselves more efficient moving forward. So whenever you see that previous diagram, think to yourself, what do the lenders want? The people that supply the funds. Well, they want an interest. They're going to sacrifice their financial reserves for what? They want a return, but they also want to make sure they're going to get their money back, so they want low risk, and they want access to them funds. They want liquidity. On the other side, on the right-hand side, what do borrowers want? Borrowers want to borrow cash at the lowest possible amount, the most efficient, the most timely. So each different person or body in this diagram may have different objectives and different requirements and different needs. So that needs to be considered as well. In this diagram, we talked about financial market. So a financial market, it's a place. It doesn't have to be a physical place, or it could be virtual. Examples of this is the various stock exchanges around the world. The London Stock Exchange is a computer warehouse somewhere in the ring of the M25 in London. If you go stand outside the London Stock Exchange, the building in London, it's just a building with some computers in it and a TV studio. It's not a physical trading place because the London Stock Exchange is all online. However, if you look at the US Stock Exchange, you'll see the pictures on the news of a floor where you'll have people walking around in different coloured jackets, the market makers and then the traders and the brokers. It is a physical marketplace where you walk around and make transactions. Some of the commodity exchanges, certainly the commodity exchange in London, is a physical place. It's a little ring where people sit and they deal across a circle seated chair. But majority of financial transactions or marketplaces are now online. But there is some places that are physical that still exist. Financial institutions, well, there was a list. We'll go through them shortly. There's two different types. There's deposit-taking institutions and non-deposit-taking institutions. We'll cover that shortly. But they're essentially organisations that are regulated to either accept deposits or to transact financial products. And they're authorised and regulated in the UK by the Financial Conduct Authority. We mentioned in that diagram the money markets at the bottom of the diagram. The money markets is financial claims and financial products that are short term, less than 1 year, and typically issued and transacted by highly liquid and relatively safe organisations. But the concept is it's greater, it's less than 1 year. The capital markets, I've mentioned that this is the likes of the bond market and the equity market. And these are long-term instruments. Bonds is long-term debt, long-term loans, effectively. Equity is shares, share ownership. You sell your ownership to investors in return for a dividend and capital growth. So these were the terminologies or the definitions from that diagram. When we talk about types of financial institution, we have the deposit-taking institutions and the non-deposit-taking institutions. Now you're probably rather familiar with the institutions on the left-hand side here, the likes of your retail bank, the likes of your investment bank and building societies. Now the concept of a retail bank, you know, the people you have your savings accounts, you might get your loans from, you might do foreign exchange from, I don't know. These are where you go on the high street into the branch, if anyone still does that anymore. Your investment bank, however, is more the advisory element. And these are the banks that take on the corporate clients. And when companies want to raise or sell shares via equity and initial public offerings, then they provide the advice. They provide advice for merger and acquisitions. And these are the institutions that potentially buy the equity from companies that want to list, but then sell it to the market via the stock exchange. But an investment bank is also the retail bank, because if we just pick a brand like Lloyds Banking Group, you might have an account with Lloyds as a customer, but Lloyds does have an investment bank arm where it does all this advisory. Potentially it's proprietary trading on the markets with its own cash. So do look up the difference between what a retail bank is and what an investment bank is. but do get the concept that the likes of Lloyds Banking Group will have a retail branch and it will have an investment branch to its business. A building society is different. It's a more traditional structure where its owners or its members doesn't have any shareholders, and its funding model is it relies more heavily on customer deposits rather than lending from the financial markets. So the two differences from a bank is its ownership structure and its funding structure. But the non-deposit taking institutions are really ones that kind of provide a service, or you'll pay a fee for something. So insurance is an easy example. You don't put your money into an insurance product. You pay, say monthly or yearly, for insurance. So you're paying for something. With insurance, you don't ever want to pay out, but it's there for security purposes to transfer risk. But you pay for something. You don't get it back unless you claim. Pension funds, again, you're paying into a pension. That's an investment that grows, and obviously in the future it will pay out. So a pension is a product. There's a difference between a saving product and a pension. You can have a read up on that. And the likes of investment trusts, unit trusts, these are more of an investment sort of thing, where again it's not a deposit, you're buying a claim to something. If you're buying shares, again that's the markets, it's the capital markets. You're buying something in the hope that you can sell it later on for a return, or if you buy it then you expect a kind of return, whether that be through dividend payment or if it's a bond through an interest payment. But you're buying a security that you will sell off later on. So you're not depositing your money with anything, you're buying something to sell on later on. So that's the distinguishment between the different types of financial institution. And just to summarise, again, recap what I said there. Here's the text to kind of give you a definition of what a retail and commercial bank does, how it differs from the likes of an investment bank. And then I've noted there, obviously, building society being different and how it's structured. But it does provide what it is banking services, but they're not a bank by definition. You may be familiar with credit unions. Credit unions are a very small example of a building society. There's another way of looking at it. They're owned by their members. They're known as a cooperative. They tend to be small in scale and they tend to serve their community. So their community, whether that be in a geographical community, whether that be a work-based community, that's what their role is. They tend to be regulated regarding the loans that they can provide. They tend to be smaller, but the rates are quite regulated and they're very low rates compared to, the alternative being a payday loan. But the concept of credit union is they only give loans to their members, so you have to have a savings account with them to receive a loan. So if you don't have an account with them, you can get a loan, but on the premise that you open a savings account. And when you pay off your loan, you also pay into a savings. So you build up a savings as well as have a loan. And they're more personable. So I used to be a member of the credit union in Newcastle, which I'm not going to spoil because it's on the next slide. But when I called them up, you literally rang an 0191 number, and the minute you rang that, someone would pick up the phone. There's no switchboard or anything. It would go straight to, oh, hi, this is Karen. Generally, she was called Karen, the one I spoke to a couple of times. So it is quite small, low key. And when you go for a loan, sometimes you get an interview because you're probably financially excluded. So most financially excluded people tend to go to credit unions for that personal touch. And if you get a loan, you might go through a computer system, but if it's kind of a financial exclusion case where you have bad credit, then the community spirit is they'll help you and they'll have a conversation to potentially get this loan. But it's also about financial education. So credit unions, very small, very community focused, and it's all more about If you remember, you remember because you want to help your fellow citizen. You don't really save with a credit union for a high return. When you save, you know that your saving is going to be paid out. So someone in your community that needs a loan or needs help. So that's how we may view it in the UK. An insurance company, well, we know what insurance is. The concept of them is to transfer risk. They don't get rid of risk. And you buy insurance, so if whatever your insurance, something happens, then your insurance will pay out to indemnify you, to put you back in the same position before whatever event it was. So obviously, an easy example being car insurance. If you crash your car, the insurance company will probably pay out for the car, either to replace it or to fix it. But the concept is of indemnity to put you back in the position before the crash happened. You're never going to profit from this, you're just going to get your car back. Or if you have a medical accident, it's going to try and compensate you and try and get you back in the position you were before said medical issue. We talked about unit and investment trusts. This is where you potentially pay for something, but ultimately they receive lots of smaller payments, pool it up and invest in the stock market, and then pay out a claim or a proportion depending on how much of this unit you bought. And we'll cover this in the last concept of this module in week 11. And we also have the credit rating agencies. And these are independent agencies, the likes of Moody's, Fitch, Standard & Poor's. And their role is to rate products, organisations, individuals on their credit worthiness, their ability to pay back. So whenever the likes of demanders of funds, businesses, want to issue a bond in the capital markets to receive money from the suppliers of funds, so if they want to sell a debt instrument, a credit rating agency will rate that bond on the likelihood of that bond being paid back. The likes of governments tend to have a much higher credit rating because they have the right to tax its population, and the likelihood of a government default is very low. But when we go through the bond lecture, we'll explain the various different credit ratings and what the credit ratings mean as you go down the scale. Typically, if you have a lower credit rating, then you must pay a higher level of interest to compensate investors for taking the risk in investing in your product or buying your product. So just to finish off this part, I've got some company logos there. It's your job to try and match these logos with whether you think they're an insurance company, credit union, an exchange, or credit rating agency. So to finish off this part, try and match the institutions, logos, and brands with the type of institution they are. And please do some research into who these people are if you're unfamiliar. And this concludes part 1. So to start with, some key terminology and the concept of a financial liability. Now when we say liability, this is what we typically mean by a debt, or something that you have to pay back to somebody. But interestingly, in financial services, banks actually transform liabilities. So think about your customer deposit. That's your asset. That's what you put in. But that asset is the bank's liability. Because that deposit, the bank technically owes you that back. Or you can claim it back at any point in time, depending on your deposit account. So a liability for you, as us, as consumers, it's probably something to do with debt. But for a bank, it's actually our deposit. Then we flip that over to financial asset. Our liability in a bank, so we owe a loan, that loan is our liability, but that's the bank's asset. That's what the bank makes money from. So a financial asset is potentially an obligation that somebody owes you. Hence why your deposit account is your asset, because the bank owes you that back when you claim to take your money out, for instance. Embedded with any financial service or product, there is risk. There's various types of risk. There's credit risk, market risk, liquidity risk, operational risk, systemic risk, foreign exchange rate risk. There's so many different types of risk. We like to say the brief definition is the probability of financial loss or gain. Don't forget that concept of risk is also a positive thing. There's two sides to a normal distribution curve, one being negative, one being positive. So risk is also a positive thing. And we'll cover the risk-reward trade-off in next week's lecture. When we talk about the concept of maturity, think of what the word mature means. It's aged. In finance, maturity is really just timescale. When does a product mature? When's its maturity date? In other words, when does it end? How long is the product? And liquidity is the concept of how liquid is your asset. How quickly can you turn your asset into cash? An easy example of this is property. Property is bricks and mortar. It takes a while to get that into cash. But some products can be traded into cash very quickly. So certain products have kind of a liquidity scale on how easy it is to transform it into cash. In times of financial crisis, this is where we see people try to scramble and sell all their assets, which depresses prices, and they're selling it to turn it into cash, which is seen as one of the safest kind of forms of finance, because you can hold it and touch it, and because it's cash, it's very liquid and can be moved about. We've covered what debt is in this lecture and this module. We'll talk about debt products from the money markets and the bond markets mainly. The concept of equity is ownership. Shareholders own equity in an organisation. So whenever we refer to equity, we're really meaning shares. Depending on which textbook you read, the definition may differ. We're going to talk about the primary market, and this is where securities are issued. So the primary market is where the likes of debt, equity, money market products, they're first offered, or they're first put up for sale by the deposit holders that want investors to buy them. So we'll talk about initial public offerings, IPOs, when companies list for the first time, as an example. So that's what's known as the primary market. The secondary market, just think second hand. It's not new anymore. The secondary market is what we're most familiar with, is where all these equities, bonds, money market securities, they're all traded. So secondary market is a London Stock Exchange. Most of the activity that happens on the exchanges, this is the secondary market. The primary market only happens once. Or, as we will discuss, when companies want to raise additional finance via new shares or new bonds, they will issue it to the primary market, but the majority of the transactions take place on the secondary market. When we sell securities, we can sell them in two ways. They can be over the counter, or acronym to OTC. So you go to the buyer and get it straight from them, or you go via an exchange. And this is where an exchange where all the market participants turn up and the market determines the price. The best example of over the counter is foreign exchange. You don't go to a market or an exchange to buy your foreign exchange. You go to one counterparty. So if you're going to go on holiday, not right now I guess, but where do you get your foreign exchange? You potentially shop around. You go to different places to see who has the best rate. Because it's over the counter, you go into the bureau de change, or however it's pronounced, and you transfer cash into another currency. So it's over the counter. But other things like shares and bonds are traded on an exchange or a platform. When you read the first chapter of your core textbook, Webb and Brahma, they break down the financial products and markets into different types. So it's the same, obviously same products, but we can classify them in many different ways, and they overlap of course, which you'll see on the next few slides, and if you read the first chapter and second chapter. We can classify products based on their maturity, how long they last. So maturity being short-term products, money market, long-term products being the capital markets. We can classify on how they potentially financed, whether debt or equity, by the type of issue. How is it issued? Is it issued at a discount or at a premium? And we can also classify them how they're traded, whether they're over the counter or via an exchange. So there's various different characteristics and ways of classifying financial instruments. So we'll just take the first example to classify by maturity. So we can compare financial products based on how long they last. So as noted in the diagram in the first part of this lecture, we talked about the markets, we talked about the money markets and the capital markets as a route between suppliers and demanders of funds. Well, the money markets, as I mentioned earlier, is short-term products that are less than 1 year, but you have the capital markets, which are the bonds and equities. And bonds can be perpetual. They don't have an end date. There is bonds out there that are 30 years long, even up to 50. So they do have an end date. But you can also have bonds that are only 10 years long, or even shorter ones at 5 years long. But equity, ownership, well, technically that's indefinite, unless the company decides to go private again or goes bankrupt. We can classify the different products by their type of financing. So type of financing, we're referring to the concept of debt or equity. So the debt instruments, or like a certificate of deposit. Certificate of deposit, we'll explain shortly, is where a supplier of funds puts their money in basically a large savings account and earns an interest. We also have the bond market. So I mentioned before, bonds are debt. There's two types of market. There's the sovereign bond. So sovereign means state or government, and corporate is companies that want to issue debt via bonds. And the other type is the equity market, where companies sell their ownership. The majority of shares out there are what is known as ordinary shares. Ordinary shares are equity that potentially give shareholders a claim to dividends, as well as any capital growth. And the holders of ordinary shares get to vote at the AGM. However, preference shares, they also get a claim on dividends, but their dividend claim tends to be more secure and may be a fixed rate and is required to be paid, because dividends don't have to be paid if a company does not make any profit. If you don't make any profit, you don't have any money to return to shareholders. So ordinary shareholders may not get a dividend in this case, but preference shareholders may still do so. In order for that extra security, they forgo their vote at any AGM. We can also determine products on when or how they are issued. As noted before, everything is issued on the primary market and then they're traded on the secondary market. So the recent examples of primary market activity is the likes of initial public offerings, IPOs for equity, as well as the issuing of bonds and the likes of government debt, short-term debt being T-bills, long-term debt being bonds. And this typically happens every Friday, certainly from a UK point of view. So typically on Fridays, the Debt Management Office in the United Kingdom announces the level of debt and what type of products they will issue for investors to purchase. But I've got up there the examples of the most recent IPOs that were quite noticeable. I've got the Saudi Aramco there, which happened in 2019, and at the moment, at the time of recording, this is the world's largest IPO, raising nearly $30 billion US. At the moment, there's still planned or predicted for Ant Financial, which is a Chinese and Hong Kong kind of financial conglomerate that's currently in the listing process and is expected to raise about $35 billion US. But that's still to be finalised. But more recently in the news, you might have seen that at the end of 2020, Airbnb listed to great success, just raising $3.7 billion US. And when Airbnb share price went trading on the secondary market, the price jumped significantly from what it was originally priced at. And that was when the secondary market got their hands on the shares of Airbnb. Just on the screen here, you can see I picked up a random example of a company that had an IPO back in 2014, and this is just a Japanese company. And whenever you have an example of a listed stock on Bloomberg, it will tell you it is pending listing. It will give you the information about it. You can click through the various tabs to see who's involved, the potentially working capital and costs of listing. But more importantly, when a company lists for its IPO, they have to provide at least 3 years worth of financial accounts. So Bloomberg, you can have a look at the information that they provide to potential investors to say whether that investor wants to buy this company at an IPO. However, you probably think, what are you looking for in these financial reports? You're probably looking for healthy profits, you're probably looking for good retained profits or good profits invested, because if they retain profits, then potentially in the future they might start giving that out in dividends instead. And you're looking for growth, lots of growth characteristics. However, if you looked at Airbnb's annual reports before listing, you'd probably think, why on earth would anybody want to buy this? A company that hasn't made any profit for the last 3 years, but made substantial losses. Well, this is not uncommon, certainly for US IT companies. There's lots of companies out there that haven't really made any profit, or certainly didn't in the first few years. But it's more the fact that they're potential disruptors. I call them unicorns. They don't make any profit yet, but they're fantastic ideas and they're changing the marketplace. So the investors think they'll be good in the future. And there's also the element which is irrational of the fear of missing out. So I've said Airbnb, other examples are Slack and Uber, all at the time of listing didn't really make any profit, or still were forecast to make losses in the years ahead, but yet there's the potential of them being excellent and game changers in the future. Also, we can classify products by how they're traded. And as I've mentioned, you have the over-the-counter market, which is predominantly the foreign exchange. Some bonds can be bought over the counter. However, the majority of bonds are actually traded on the London Stock Exchange or various stock exchanges around the world. So majority of bonds are actually traded in a marketplace, but some are over the counter. But the likes of physical exchanges, majority of commodities, majority of equities, bonds, money market products are all on a physical exchange. And this picture you can see here is from the New York Stock Exchange, which I mentioned earlier in part 1 that it is an actual trading floor. So let's briefly go through some of the products now. I'm going to start with the money market products. Like I said, we'll have a full lecture on this in time, but the money markets are wholesale. So wholesale means large amounts. We're talking about billions and millions rather than small amounts of money. So you have to be a big player to use the money markets. It's mainly governments and banks and corporates or very high net worth individuals. They're products that are less than 1 year, short term, typically under 270 days because of US regulation. They're classed as low risk because they're short term and because they're issued by governments who have a high credit rating, but also financial institutions and corporates that have a really high credit score. So they're typically classed as low risk because of timescale and who's involved in this market. And because they're short term, the interest rate charge isn't massive. So because they're small rates, obviously small rate on a large amount of money, we use the concept of basis point. So we say 1 basis point, and that would be 0.01%. 100 of 1%. If we said 25 basis point, that's a quarter of 1%, or 0.25. So typically, when the likes of the Bank of England change the base rate, they normally change it by 0.25, or we'd call that as changing 25 basis point. So let's have a look at the money market products. And there's 5 to remember. We have the treasury bill, the commercial paper, the certificate of deposit, and banker's acceptance. And then a product that works slightly different is the repurchase agreement. That's why I put it as the thumb there. We'll briefly go through each one in turn now. So we have the T-bill, treasury bill, so short-term debt issued by the governments of many various countries. So we have an example here, and this is how it normally works. The government would announce the product. Each product has a typical face value, so for easy sake we'll say every T-bill is £100. Investors buy it at a discount, so the investors would buy it on day one for say £95. They'd hold it for the short period, then at the end of the product the government pays back £100, so the investor would make £5 in this case. So it's what's known as issued at a discount. And all we need to do is go to Bloomberg, look at government auctions, and like I said, every Friday there'll probably be a list of how much money the governments want to borrow, and it'll potentially give you, in this example you can see at this time they're issuing T-bills for a month, half a year, or 3 months. The other products are the commercial papers, which is exactly the same as a T-bill, except from it's issued by a company, not a government, so a different level of credit risk. Certificate of deposit is just a really large savings account. If you have a surplus bit of cash, you'll place it into a certificate of deposit for a short period, and at the end of that period you'll return an interest on top of your deposit. And the banker's acceptance is a kind of certificate of deposit between different banks during a typical trading process of large shipments and international transactions between two companies. So 2 companies will agree to make a trade of a large amount of goods, and trading around the world takes a while. So to ensure that the one firm is going to pay another firm, the banks of each firm make an agreement that one bank will pay the other bank the sum of the money of this international trade. And whenever that agreement's been made, then if one of the firm wants to get their money quicker, then they have this banker's acceptance which they can already sell off to someone else to get the funds quicker than waiting for the international shipment to be made from one place to another. But we'll explain that in more detail during the money markets lecture. And the last one of the money markets is the repurchase agreement. And as it's in the name, it's an agreement to purchase something back. So if you want to make money, what you can do, you can sell off one of your securities to another bank and they'll pay you cash for that, but you agree that you'll buy that security back later on and you'll have to pay a little bit more money to buy it back. So you sell something, receive some cash for it, but then you buy it back and pay a little bit more for it. Typically, the securities involved are T-bills, so you'd sell something short term, really safe, really secure. But you'd only do this to access cash, to transform that security into short term cash. So we'll explain why repos are used in the money markets lecture. On Bloomberg, we have the Bloomberg Treasury Money Markets function, BTMM, and on here you can go and have a look at the various rates of the short-term product. So if we just look at this example, we have the overnight rate potentially being 68 basis point. Compare that with 1 year, and that would be 118 basis points return on a product that's year long. I want you to go on to Bloomberg now and have a look at how these rates differ following the COVID crisis and when interest rates got slashed. What you may actually see at the time of recording is that the overnight rate might actually be negative. So think about, what does that mean? What would negative basis point mean? I'd like you to pause the video now and have a look at this characteristics table of how we might classify the various money market products via their term, how their interest paid, and their quotation. We will go through all of these characteristics in detail in the money market lecture, and it is worth pointing out that this table is very examinable in the future. So when we go through the money markets lecture, do pay attention to the various characteristics of each of the 5 products. Let's move on now to the capital markets. We've already mentioned that there's the primary market and the secondary market, but the capital markets really are shares and bonds. And when we talk about shares, we talked about ordinary shares and preference shareholders. What you can see here is a quick summary of the difference between them. They are both ownership. You both own the company if you're a shareholder, but the difference between ordinary and preference shareholders, as we mentioned before, is the voting rights at the AGM and the potential claim to their profitability in the form of dividends. So we'll go through that in more detail. On Bloomberg, we can look at the various world equity indices, which is the WEI function, which will give you a list of the stock exchanges and how they're performing on that day. A stock exchange, or one of these indexes we're looking at here, is just the overall summary of the daily performance of how the company shares are performing. So if all the company's share prices are increasing on one day, then the index that they're on, say the FTSE 100, will also go up. So the FTSE 100 is a collection of all the top 100 market capitalized companies in the UK, and if you pool all them 100 together and you average out their daily performance, that's what's reflected in the FTSE 100. So when we talk about bonds, we refer to bonds as debt. You may also hear the term gilts. Gilts really refer to government debt or government bonds, but the still umbrella name is bonds. This is a debt instrument where a company would issue this bond, investors would buy this bond, and then the company has to pay a coupon, a level of interest annually, and in this example here it's 3.5%, and it's simple interest. So if we say the par value of a bond typically is £100, if you bought this bond, then every year you'd receive £3.50 as a coupon payment up until 2045. We can classify bonds into various different types. The typical one is what's known as straight, plain vanilla or bullet, and that's where a company issues the bond, investors buy it, it pays that coupon until the end date, then it ends. But we can have various different deviants from that, where they can be bought back early, they can be converted into shares, they may not actually pay a coupon, they may just be issued at a heavy discount, so the investor buys it, say at £50, but then in 30 years time they'll receive £100 back. So the coupons are typically fixed interest, but they could be variable, linked to something. So in the bond lecture we'll cover various different characteristics and different types of bonds as well. On Bloomberg, we can also look at the security description of any bond, which will give you the information about when it was issued, when does it end, how much was raised, is it secured against anything, what is the credit rating of this bond. So all of that is available via the bond security description page in Bloomberg. And to continue and finish our journey of the various different terminologies we may come across, we can talk about the different types of investors. These are the 3 concepts that you may have heard of already: speculators, hedgers, and arbitragers. The easiest one is speculators. They're buying products or trading products in hopefully to return some sort of financial gain. speculating on future share prices, for instance, buying shares in the anticipation that they'll increase. Hedgers are people that use financial products to mitigate risk. The easiest example of this is the derivatives market, which we don't cover in this module, but you have a whole new module next year on derivatives. Think about this. Typically, how often in advance do you buy an airline ticket when you go on holiday? Typically, you're buying that airline ticket a year in advance. How does the airline know the price of oil for its fuel in a year's time? That's because they've already potentially hedged the cost of the fuel in a year's time by locking into the price today using a financial derivative like a future or forward. So you can use financial products to lock in prices for the future. And then there's the arbitrages. These are individuals or computers that spot price differences in different markets, and they would simultaneously buy and sell in the different markets to make a gain. But by doing so, you're changing supply and demand, which will instantly correct the price to make sure the asset is the same price in different markets. So they'll spot a price difference, buy and sell simultaneously to correct this. They'll take obviously a bit of advantage from that, but then it really makes the market more efficient by correcting the price in both markets. Typically this is done by computers nowadays. And then finally we'll finish off with discussing central banks. Now at this stage it's worth mentioning that central banks differ around the world. They have the kind of same characteristics, but their role or independence will differ depending on the country they're in. But the typical functions of a central bank is to issue the currency and maintain the stability of the currency. They issue in the banks, notes and coins. They typically supply the amount of money in the economy, and as part of that, their role is to keep inflation down, and typically they do that by monetary policy, and we'll talk about that when we go through the interest rate lecture. Typically, central banks are the government's banker, and they're also the lender of last resort when it comes to the financial system. As I mentioned earlier, financial institutions need to hold a certain deposit with the central banks, and typically this is their reserve account, but also in the concept of lender of last resort, that's where the likes of banks may go to the central bank to do repurchase agreements to get short-term liquidity. So the central banks around the world do have different characteristics and independence, but typically these are the main functions of a central bank. But then you also have to think, who's the central bank of the central banks? This is where you'll need to have to look up the role of the IMF, the International Monetary Fund, which is a collection of central banks. But also think about things that I haven't included. Is the central bank the regulator in that country? As I mentioned in part 1, the UK Central Bank regulates the safe and soundness of the financial system in the UK, but it doesn't regulate the conduct of individuals. So a central bank, depending on the country, may also be the regulator or part of the regulator in that country. Here are a few images of central banks from around the world, so I'll let you now take some time to try and work out whose central bank is whose. And this concludes week 1's lecture on the financial system and giving you kind of a whirlwind of the various products. But do bear in mind the concepts that we'll cover today, we will go through them week on week throughout the rest of this module. But it's good now to do a brief reading and a brief understanding of what each product is. And as part of your directed study, as I mentioned, I want you to read the first few chapters of Web Brahma, familiarise yourself with all of the content available. If you haven't already, make sure you sign up for Bloomberg, start learning, and we'll go through it in the seminar to start with. And then go through the various topics we've covered, look at the various product types, We'll also need to know these product types in your NX9410 project where you're going to invest in the likes of bonds, equities and alternatives. So make a start now, and then the lectures in the future weeks will be much easier. So thank you for watching today, and all the best.